Welcome to the deep dive. Today, we're looking at something new for Canadians saving for their first place. The First Home Savings Account. You might have heard it called the FHSA.
That's right. We've gone through the official details and what experts are saying.
And our goal is pretty simple. Cut through the noise and give you the essentials you need to understand this FHSA thing. No info overload, promise.
Exactly. You probably know about RRSPs, TFSAs. Well, now there's this. We want to make it super clear how the FHSA fits in, especially if you're thinking about buying your first home.
Okay, let's jump in. So what exactly is an FHSA? Like, what's the main idea?
Well, it's pretty interesting, actually. It kind of blends the best features of an RRSP and a TFSA.
How so?
So when you put money in, your contributions are tax deductible. That lowers your taxable income for the year, just like an RRSP.
Okay, tax deduction up front.
Right. And then the really appealing part, when you take the money out to buy your first qualifying home, that withdrawal is tax-free, like a TFSA.
Okay. Tax break going in, tax-free coming out for the house. That does sound good. Who can actually open one?
There are a few boxes to tick. You need to be a Canadian resident, naturally, and at least 18 years old, or the age of majority in your province.
Right.
And the main one, you have to be a first-time home buyer.
What does that mean exactly?
It means you haven't owned a home that was your principal residence, either in the current calendar year or in the previous 4 calendar years.
That 4-year look back?
Mm-hmm.
That sounds familiar. Isn't that just like the rule for the home buyer's plan, the HPP withdrawal from an RRSP?
You got it. It's the exact same rule. They've kept that consistent, which, helps a bit.
Okay, makes sense. So if you qualify, how much can you actually put into this thing? Are there limits?
Yes, definitely limits. You can contribute up to $8,000 per year.
$8,000 a year.
And there's also a lifetime limit of $40,000 in total contributions.
40K lifetime. Got it. What happens if, say, you only put in $5,000 one year? Do you lose that extra $3,000 a room?
No, and that's a great feature. Any unused contribution room from one year gets carried forward to the next.
Oh, okay.
But there's a cap on the carry forward you can use in 1 year. You can add a maximum of $8,000 of carried forward room on top of the current year's $8,000 limit.
So you could potentially contribute up to $16,000 in a year if you had enough carried forward room.
Let me clarify that slightly using an example like Torkel's from the source material. Say in year 1, he puts in $5,000. He has $3,000 unused room. In year 2, his limit is the current $8,000 plus that carried forward $3,000. So $11,000 is his contribution room for year 2.
Right. Okay, that clarifies it. $8,000 current plus up to $8,000 previous unused room, but capped by your actual unused amount.
Good. And how do you make contributions? Is it just cash?
Yes. For now, contributions are made in cash.
All right, let's talk more about those tax advantages. We mentioned the tax deduction. Can you break that down a bit more? How does it help me right away? Sure. When you contribute, say, $8,000, you deduct that amount from your income when you file your taxes for that year. So your taxable income is $8,000 lower, meaning you pay less income tax that year. It's an immediate tax saving.
Nice. And while the money's in the FHSA, may be invested, is the growth taxed?
Nope. Any investment, earnings, interest, dividends, capital gains, it all grows completely tax-free inside the FHSA, similar to an RRSP or TFSA in that respect. It helps your savings compound faster.
Tax-free growth, always good. And then the withdrawal, you said tax-free for a home.
That's the key benefit for home buyers, yes. If you make a qualifying withdrawal to buy your first home, the entire amount comes out tax-free, principal and growth.
Okay, qualifying withdrawal. What makes a home qualify?
It has to be a housing unit in Canada. And crucially, you have to intend to live in it as your principal place of residence within 1 year of buying or building it.
So your main home. And do you need proof you're buying?
Yes, you need a written agreement, like a signed purchase and sale agreement to buy or build that qualifying home before you can make the tax-free withdrawal.
Okay, formal agreement needed. Now, lots of people use the RRSP home buyer's plan. Can you use both the FHSA and the HBP for the same house purchase?
You absolutely can. And this is a really powerful combination. You could potentially take out your $40,000 tax-free from the FHSA and up to $35,000 from your RRSP under the HDP.
Wow, that's a significant chunk of change for a down payment together.
Yeah.
Is there a difference in how those withdrawals are treated long-term, like repayment?
Big difference here. The HBP withdrawals from your RSP, you have to pay those back into your RSP over 15 years, starting a couple of years after the
All
withdrawal.
right, the repayment schedule.
But the qualifying withdrawal from your FHSA to buy your first home, no repayment required, ever. It's just tax-free money for your home.
That's a huge advantage for the FHSA then. Okay, but what if life happens? You open an FHSA, save up, but then plans change, you don't buy a home. What happens to the money then?
Good question. You've got options. The primary one is you can transfer the funds tax-free directly into your RRSP or even RRIF.
Ah, so it can roll into your retirement savings without immediate tax consequences.
Exactly. The contribution doesn't use up your RRSP room, but the transfer itself is tax-free, preserving that tax-deferred growth.
That's good flexibility. What if you
Yeah.
don't transfer it and you just take the money out for, well, something else? Not a house, not retirement.
Then it becomes a taxable withdrawal. The amount you take out gets added to your income for that year and taxed accordingly. So the tax benefits are really linked to either buying that first home or rolling it into retirement savings.
Got it. Okay, let's quickly sum up. What are the absolute key takeaways for the FHSA?
I'd say number one, tax-deductible contributions, reducing your tax bill now. Number two, tax-free growth while the money's in the account. And number three, tax-free withdrawals for buying your first qualifying home.
And no repayment needed on those withdrawals.
Crucially, yes, no repayment. Also remember the contribution limits, $8 care annual, 40 tie lifetime, and the carry forward option.
And the first-time buyer definition is important too.
Definitely. That 4-year rule is key.
So it really sounds like a powerful tool specifically designed for that first home purchase.
It absolutely is. It slots in nicely alongside RRSPs and TFSAs, each serving different goals, but the FHSAs is laser focused on helping you get that down payment together with significant tax advantages.
This has been super helpful, really clarifies things.
Hmm.
If someone listening thinks, okay, this might be for me, what's a good next step?
Well, first, double check your own eligibility, especially that first-time home buyer status. Then look at the detailed rules on the Canada Revenue Agency website. The CRA has all the official info.
Right.
And, maybe chat with a financial advisor. They can help you see how the FHSA fits into your personal financial picture alongside other savings you might have.
Sound advice.
Mm.
Always good to get personalized guidance. Okay, a final thought for you to ponder. With this FHSA now in the mix, how might it reshape the way Canadians think about saving for homeownership and maybe even their longer-term financial planning? Something to think about. Thanks for joining us for this deep dive.